Hi everyone, this is Craig the Options Linebacker, and this is the weekend report for Saturday, November 7th. Now stick around at the end of this video because I'll show you where you can get some free stuff. So as we get into the charts here, the two most interesting index charts that I am following right now are those of the Dow and the Russell 2000. The Dow is obviously those blue chips, the big caps, those 30 stocks that represent the true industrials of our economy. And the Russell 2000 are the small cap stocks, the smaller companies that are still gone public but don't have the strength in the following that the blue chips do. If you think about these stocks, these are more conservative and the Dow, and is a safer play, especially after a 56% rally, whereas after an 82% rally, these higher beta stocks here in the Russell 2000 are certainly considered to be riskier because they're less liquid. They're more difficult to get rid of in quantity if you're a fund manager that has accumulated several shares. It's tougher to get rid of them without moving that actual market in that stock. So as we compare these two charts, this makes total sense because the Dow right now is just a place where, you know, it's still making higher lows, higher highs, it's still working itself higher, and right now is considered a very safe place to put your money after a rally of this magnitude. Whereas the Russell play off the bottom, if you were lucky enough to get off the bottom, you know, what a magnificent rally that you got a piece of, but it's done, it's over right now, and it needs to retrace. We've double topped. In fact, the Russell's put in a slightly lower high and a significant lower low. So there's a change of primary trend here to a primary downtrend. The Russell does tend to lead. It tends to lead off of the bottom, and it tends to lead at the top. If you go back and look at the summer of 2007, you'll see that the Russell actually started the bear market before most of the other indices. The high that it put in October of 2007 was a lower high. What the Russell is telling us is that we may be getting into at least a consolidation area. So if we apply that to the S&P 500, which is my favorite index to track, we can see that the price has been making higher highs, higher lows, all the way up. But if we're saying that it might consolidate soon, where might this fail? Well, let's put our fibs on. So we're going to draw our fibs from the recent top at 1100 in mid-October until the recent bottom, which we just had, and we can see that we have several lines to play with here. What do these mean? What do we do with them? Well, what we have are for this swing here, we have retracements at 38%, which is 1057. We have 50%, which is around 1066, 1065. And then when we have the 61.8% retracement up at around 1074. Now what we typically find is that if the chart is going to bounce and start heading a little lower, it'll do so after finding resistance at one of these three levels. So obviously the price has gone through that 38% at 1057, has gone above the 50%, and now the last line of defense for the bears is this 1074 level up here. And I'll just say, for these purposes, since we have a little high up here at 1080, the range from 1074 up to 1080. So if it doesn't bounce at this level and start heading down again and moving into a potential primary downtrend, then the odds have improved for the price to go all the way back up at least to the 1100. So for right now, what we have to watch in the S&P 500 is how the price handles this zone here at about 1074 up to about 1080. And it's that simple. It's a little bit more complex if we look at the Russell 2000, however, because the price has come up and has stalled right at that 38.2% retracement, now, which is also coincidentally in confluence with this breakdown level at 580. So this is typically what we see, is that stocks will break down, come up and retest that breakdown level again, and then fail from there. Remember, the Russell is in a primary downtrend. So what we're looking for is not necessarily to see it go from a lower low straight up to a higher high again. That's probably unlikely. What we're going to look for it to do is find a lower high at one of these levels, whether it's 580 at the 38.2%, 50%, or at this confluence up here, which is around 597 to 600. So we're going to say the last line of defense for the Russell bears is right around the 600 area. So we would expect to see a bounce come at or before that area on the Russell for it to remain in a primary downtrend. If it gets past the 600 area, then the odds have improved for the Russell to go straight from a lower low back up to a higher high here at 624, but again, the odds are against it. So since we trade the Iron Condor, let's take a look at our positions. Right now we have 2 months in play right now. In November, we have a 116 strike up here on the call spreads, and we have a 91 strike down here on the put spreads. The price is right in the virtual center of the Iron Condor, and we're looking great with 2 weeks left to play. For December, we have a 115 strike up here on the call spreads, and we have a 93 strike down here on the put spreads. And again, price is right next to the virtual center of that Iron Condor. You always want to have more distance to the downside. Positions are looking really good either for the November or the December cycle. And I'll finish out today's video by looking at the delta neutral P&L curve. And it's a funny looking P&L curve for an Iron Condor. However, because we have butterflied off or hedged to the upside on this particular trade, you can see where the P&L is right now. This is the current price, and so we're just above the max profit spike on this trade. However, with continued time before expiration, what you'll see is that price will, or the max P&L will start to fill into that butterfly shape. We're also looking very good for this trade, and we'll probably end up looking to take early profits on this trade sometime within the next week or so. So that's it for this weekend, and thanks for watching. Make sure that you tune in next week for more in the markets. Really quick before you go, we just released a new product called Traders Fast Track, which is an inexpensive trading success program. If you go to the link in blue, we have a special offer where you can get our premium daily newsletter free for a whole month at optionslinebacker.com/fasttrack2. We also have some brand new free stuff for you. When you go to that Fast Track page, you can sign up for a free monthly newsletter dedicated to how successful traders operate, our Fast Track newsletter. You can also instantly download our brand new ebook for free, Technical Analysis for Options Traders, which shows you how a few simple yet powerful reads in the market can help improve your options trading profitability. Good trading. See you next week.